Welcome back to the Financial Firepower. In today's video, we're going to talk about one of the most important concepts in investing, building a diversified portfolio. If you want to minimize your risk while still maximizing returns, diversification is key. So what exactly is diversification? Diversification is the practice of spreading your investments across different types of assets to reduce risk. It's like not putting all your eggs in one basket. Instead of relying on a single stock or asset class, a diversified portfolio balances risk and reward by investing in a variety of assets. This way, if one investment underperforms, others in your portfolio may still do well, keeping your overall returns steady. Why is diversification so important? Well, no one can predict exactly how the market will perform. Some investments will go up, others will go down. It's the natural ebb and flow of markets. By diversifying, you spread out your risk so that a loss in one area won't derail your entire portfolio. In fact, studies have shown that a diversified portfolio not only helps reduce risk, but also can improve your chances of earning better returns over the long term. There are several ways to diversify your investments. Let's break down some of the most common asset classes. Stocks: investing in companies through the stock market. Stocks can offer high returns, but they're also more volatile. Bonds. These are loans to governments or corporations. Bonds are generally lower risk than stocks but offer more modest returns. Real estate property investments, whether residential or commercial, can provide steady income and long-term value appreciation. Commodities, things like gold, oil, and agricultural products. Commodities can be a hedge against inflation, but are often more volatile. Cash or cash equivalents. These are low-risk, highly liquid investments like savings accounts or money market funds, but their returns are minimal. Diversification isn't just about investing in different asset classes. You can also diversify within each asset class. For example, if you're investing in stocks, don't just buy shares in one company or sector. Instead, spread your investments across different sectors like technology, healthcare, and consumer goods. That way, if one sector takes a hit, the others may balance things out. You can also diversify by geography, investing in both domestic and international markets. This way, if one region faces economic difficulties, your investments in other regions may still perform well. Now that we've covered why diversification is important, how do you actually build a diversified portfolio? Here's a step-by-step guide. Step 1. Determine your risk tolerance. Are you comfortable with taking on higher risk for potentially higher returns? Or do you prefer a more conservative approach? Knowing your risk tolerance will guide your asset allocation. Step 2. Choose a mix of assets. Based on your risk tolerance and financial goals, select a balanced mix of stocks, bonds, real estate, and other asset classes. Younger investors might lean more heavily on stocks, while older investors may prefer bonds or cash equivalents. Step 3. Diversify within each asset class. Spread your stock investments across different sectors, and consider adding international exposure to your portfolio. Step 4. Regularly rebalance your portfolio. Over time, your asset allocation can shift as certain investments grow faster than others. Rebalancing helps you maintain your desired level of risk. By following these steps, you'll create a portfolio that's better positioned to weather market volatility and grow steadily over time. One of the biggest mistakes investors make is putting too much money into one type of investment, like a single stock or sector. This can be a risky move if that investment doesn't perform as expected. Another pitfall is not rebalancing your portfolio regularly, which can leave you with more risk than you're comfortable with. A well-diversified portfolio reduces these risks and sets you up for more consistent growth over the long term. Let's recap. Diversification is a powerful tool for managing risk and maximizing your investment returns. By spreading your investments across different asset classes, sectors, and regions, you protect yourself from market downturns and set yourself up for long-term success. Remember, diversify across asset classes and within each class. Match your portfolio to your risk tolerance and goals. Rebalance regularly to stay on track. If you found this video helpful, don't forget to subscribe to the Financial Firepower for more tips on building wealth and achieving financial freedom. Let us know in the comments, how are you diversifying your portfolio?